All right, well, happy Valentine's Day, everybody. The market finished the week with a little bit of a pause, a little exhale, something we haven't seen in a while, but there's been some interesting trends. Bonds have been going up to its all-time highs. Stocks have been going up. Real estate made a huge move this week. Safe haven trades are up. Gold is up, and stocks are up. So it's an interesting dynamic. We're as bullish as we are in equities, as strong as this trend is. It's not exactly the most risk-on environment. So we're going to break that down and what that means and how that impacts what we do and what our expectations are. And then we'll take a look at a trade idea on a stock that's kind of on a nice steady trend itself and what we can do with that. So let's go ahead and get started. Today is Friday, February the 14th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast indicator here on the S&P 500. You can see we still have a strong bullish intermediate posture. Long-term market sentiment still up above 80, has been for a while now. But this posture now, we're going on. Remember, it started here on October 15th, so that's 4 months now that we have been in this that the intermediate line has been the upper reversal zone. This is a pretty good period of time without an adequate pullback that would bring that would even bring the pullback below the 23% level, much less bring the intermediate line below 50. So basically one big run so far that we haven't had the dark pink shading and the red line and dark pink shading yet, like we did really here briefly on the Russell 2000. You can see as the S&P 500 continues to move higher and higher and higher. That's not the case in like the Russell, and it's mainly because of what's going on in the Nasdaq composite. You can see even the Dow pull back today. So those big large cap tech names, Nasdaq type names, still really leading this market higher, maintaining what is a strong bullish posture. We talked about today in our technical analysis class that the S&P 500 now has gotten up above the upper reversal zone. We also looked at the DMI too, and we scanned for stocks based on the linear regression. So we made a few trades today in our class based using that linear regression. But in the first part of the class, we did look at how it compared with that linear regression trend line, as well as the ADX. The ADX really peaked significantly right here, which would have been typical with an intermediate pullback. The problem is we haven't had one yet. This is also very typical of when you get this big jump up of a intermediate pullback. They usually start at the beginning. The ADX didn't really peak well enough like it did here, but they tend to start right at the very beginning of these intermediate pullbacks. For an example, if you go back a few years, the last two market sentiment, there's the last market sentiment pullback. You can see how it started with this big jump higher in the negative, and then there's the one before that. Again, big jump higher, and you can see that intermediate line ended with a jump in the ADX. This one didn't. Right, this one didn't have a big jump in the ADX, but some of these others did, and you can see this one now too. And over here, this intermediate run actually ended with a jump in the ADX, and some of these others, this one ended with a relative jump higher in the ATX, and this one not as much. But you can see how the DMI and what we never really did get a big jump higher here in the negative directional index, but we did get a big jump in the ADX. So according to that, probably should have been more of an intermediate pullback here than what we're getting. And then you can see on the DMI, we're really setting up for a divergence play on this progressively lower highs in the positive directional index and easily higher lows on the negative directional index. So something to keep in mind as this trend strength remains. It has really dropped off. It's back to close to a moderate strength trend, but on the weekly chart still remains really, really strong and really high. But you saw on the daily chart how when we had a strong trend, we started the pullback. That's kind of what it was telling us, but it didn't quite finish. And you can see all we really got down to here was the 23% Fibonacci retracement level, and there's no intermediate pullbacks until you break that 23% retracement level. That's when you get into the retracement zone, and the big support chunk in that zone is starts at the 38% level. So kind of watch. I mean, we're not back on a strong trend. We're probably not going to have this kind of move right now, but you can kind of see how, when you pull back, and this is probably what we should have pulled back and look like. But we never did get that, and so just kind of watch now for some as choppy as it gets. If I go back to the market forecast and then pull up a few extra days here on the time expansion to go out to May 1st, you can see that's where the next Fibonacci time series line is, and we're still right around this one. This is where these major lows and highs can occur. There's typically a low point around this area just from a seasonality standpoint. Obviously we didn't get that. We were on our way, but we didn't get that. We jumped up probably a little sooner than we should have. We should have probably come down here, hit that support right around the time series, formed that low point, and then ridden this fan higher until we got to May 1st, which is typically from a seasonal standpoint where a high point is. It's not like we tank, but we stop going up. Right? We typically have a pretty decent run. In fact, I'll show you here on the seasonality chart, and then let's go to a 20-day or 20-year, and then show that price as percentage. And you can see here, by the time we get to right around May 1st, April 30th, we've had a pretty decent run, and now that's when the choppiness starts to occur. So that's right where that time series line, the next time series line is. So it kind of gives us an idea of what to expect. That's where I expect the next intermediate run to end, and we haven't even finished this one, much less started a new one. And so that would have been more ideal had we started one. We came pretty close, but didn't dip enough. You notice the near-term line never did dip in the reversal zone. It's pretty rare to ever get, which kind of again shows you that this wasn't enough of an intermediate pullback. Because you notice when you do get the intermediate pullbacks, the near-term line drops in the reversal zone on all of these, and you can see over here, this is the last one where we really didn't drop into the reversal zone. So it's not too common for that to happen, but you also notice again, no red line, no light dark pink shading either. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today. Number two, you want us to do it again on Monday. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment, what did you get out of our video today? Join our website at marketscholars.com. There's a link up there in the top right corner of your screen. Click on that link. It takes you to a page where you can subscribe for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching the video on our website, check out the other classes and Market Outlook Live and all the other resources that you have here. Just click on any of these to get more information on it. We also invite you to engage with us on social media. Click this heart. It opens up this window. You can like today's Market Outlook tweet. Click this thumbs up. It takes you to your Facebook page. Again, the more you engage with us, the more those platforms will promote our content to the top of your timelines. They only promote the content that you engage with, so we try to make it really easy for you to do that. Alright, let's get back to the charts here, and let's take a look at the long-term chart for the S&P 500. Very bullish Hakinyashi candle again. Again, I don't think that was enough of an intermediate pullback. You can see the differences there. That was probably the closest one that we saw, and again, that was one that the near-term line didn't get down there. So, but also, this is a little different, that we only had about a 4, 5, 6 week move. Whereas here, obviously, we had about, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15 weeks before. And the typical run's 4 to 13 weeks. So that kind of gives you an idea of how extended we are here and whether or not we are, how mature this trend is. You can see the PPO is relatively high, higher than it's been here in a while in terms of how bullish this strength is here. There's been a few other times. If I were to move this now to 6.6. Oops. I hate that noise. You can see it's pretty rare when we're this bullish. All the other times we were coming off of some significant low points, and we're kind of coming off a significant low point. The difference is that we had a few little pauses here first. This is more the low point that we're coming off of. So pretty bullish move, and there's obviously the other significant low point we have, and it's hard to be too much more. It's hard for this line to get going too much further to the upside. That doesn't mean we'll go down. It just means that we'll most likely start to slow down if we haven't already, right? Well, obviously we haven't because of the big bullish candle we had this week. But at some point in time, we'll start to converge again on this line. We had a little bit of a convergence here. Let me go back to a full year. On the MACD and stochastics, the MACD is almost getting close to where we don't have that divergence anymore. Same thing with the stochastics, both above rising moving averages. You can see a strong, somewhat of a strong surge, about as big as the original surge on this run. So it has all the looks of an intermediate, beginning of an intermediate run, just without the pause, without enough of a pause in between. And again, not nearly as strong as some of these other beginnings of intermediate rallies that we've had. And of course, you have to flirt with you have to get below the 8-day moving average before you start to really converge on those lines there. All right, if you take a look at the intraday charts for the S&P 500, you can see we had a pretty decent move on Tuesday to break out, and we've been pretty sideways the rest of the week. But we did break up, close near the high of the week. Here, obviously, the low of the week was at the open on Monday, so it's about as bullish of a pattern as you can possibly get. There's not very much support below us until 331.50. Very little volume, obviously very little resistance to the upside either. So keep that in mind right now in terms of how bullish we are. There's not a whole, it's not like we're breaking through resistance, and we're getting relatively high. If I were to zoom out here and look on a little bit longer term, you can see there's some layers. There's that 331.50. That's the next layer of support. And then, of course, as I've shown you before, on the daily chart, there's your 330. There's your next volume node. You've got multiple nodes, but these are all relatively small volume compared to the biggest nodes that you have way down here at 300. So it's been a gradual ascent on light volume that doesn't allow for a lot of support to the downside. And if you look at it on a little bit longer term chart, it even shows up even more so there. You can see, again, there's that 300 level down here where the volume really starts to pick up on the 5-year basis. But you see how little the volume is until you get down to that level. Again, that's that kind of gives you that. This just shows how big and fast this move has been, and the faster and bigger it is, the less support and foundation it has to hold it up. So just something to keep in mind on. Again, that's not something to tell you not to be bullish, but it is something to tell you to be aware of the possibility of a bigger drawback than you may be comfortable with. We had a pretty regular move all up to this time, but the more the move gets irregular to the upside, the drawbacks would be irregular too. And for a lot of people, if you're more bullish now than you were over here, that can be tough. But if you're less bullish, still bullish to make money as we move up, but less bullish, it will still hurt. It just won't hurt nearly as badly. Again, portfolio balances will have highs and lows too, as they trend higher. So keep that in mind. I mean, you will pull back. If the market pulls back, your portfolio will pull back. You just don't want it to pull back more than what you gained since we rallied here in October. Because you got more bullish at the end of the run than you did at the beginning of the run. So let's take a look at today's range and volume. Volume picked back up to 64 million. The range really dropped. It's half of the average, and the average is relatively higher than where it was. Where's the? Here it is. The average 1.5 points way down here, and we are moving back below the 1% mark, and the volume is picking up here. One thing to keep an eye on over the last few days, and there's an error here on the data from Thinkorswim. What would that be on the 11th? So that would be Tuesday. Then on Thursday, you can see the trend got up to 106. Let's see, it was right. And that's the moving average. It would be It's right about there. 0.94 is where the trend ended up on. Well, there it is. It tells me 0.94 there. That's actually where my cursor was. Oh, it tells me right there. 0.76 is where it closed on 212. But then by 213 and 214, we're back up to 1.3 and 1.41. Again, what that tells us, and before that zero, we were at 1.31 and 1.48. So if you were to take, the last 10 days here, which is heavily influenced by the zero level, here the moving average is heavily influenced by the zero level. So if you were to take this right now it's at 1.01. If you were to take that 1.01 multiply it by 10, which is the 10-day average, right? That's what gets you to the 1.01. But then divide it by 9, because one of these days is a 0, and that's not legitimate. Obviously there's something wrong with that data point. That actually puts the 10-day average here, which would be a 9-point average, right here at 1.12. So not nearly as low as it seems here on this. I mean, it is lower. We don't have as much volume, but you can see over here, as we started to get a pickup in volume to the upside, we were this 1.12 area. That's where we had started to ramp up to that level. Here's 1.12 right here. So we're not out of the woods yet. We're getting what this tells us is we're getting more declining volume than we are advancing volume. And then the other thing too that kind of tells us that we're not out of the woods yet, besides this late little push we had at the very end, was volatility dropped off right at the very end there and broke below 0.9. And we'll see how much of a breakout that was. But until this last hour, we really weren't able to break down below this important support level. So on Monday morning, we need to keep an eye on whether we bounce back up or where we are in relation. If we break below 0.9, then we're going to keep trending up for a little while. Maybe go that 5 months like we did going into January of 18, where we had a 5-month intermediate rally. Otherwise, if we break back up above 0.9, move back up into the neutral zone on Monday into next week, then that's going to give us an idea that there's a little bit more to worry about here. Again, as I think I've shown you multiple times before, if you pull up a comparison chart here, there we go, and pull up first of all crude oil, right, over this past 4 weeks, and let's just go out we can go out 90 days here. So here is crude oil, where stock markets really peaked right here. You can see crude oil was already on a decline, but obviously we're not, still not anywhere close to these highs. We finally got up above these old highs over here, kind of lining up with that high in the equities. But you can see still how low we are and how much of a divergence there is between the S&P 500 and other kind of safety asset classes. You can see yields not really bouncing up as much. Oops, sorry. I need to bring this S&P up, and then I need to change this to yields. You saw yields right on top of crude oil. But there's the discrepancy there. In fact, here you can see crude oil and yields. It won't really show us as well on this, but crude oil and yields are really kind of right on top of each other. Okay, let's change this to an hourly chart. And actually, I'm going to go this to the 10-year yield. There we go. And then let's change this to CL. You see how they're right on top of each other, really pretty much since the beginning of the year. If I were to do the same thing with the Russell 2000, you can see similar, not right on top of each other, but not nearly as bullish either as equities have been since the beginning of the year. So we haven't really had the big full-on risk appetite move. We did over here. Everything was moving up higher, but since the beginning of the year, it's been relatively choppy. So to summarize, the posture remains strongly bullish, and there are cracks in the sidewalk, there are red flags, whatever you want to call them, and there's plenty of them to be aware of and to manage. Right, there's definitely increased risk factors that are out there for this bullish trend. Not enough to say, you know what, even though we haven't started the reverse yet, I'm going to go ahead and bail. But there are enough to say let's manage this and manage our risk on any new trades, and just make sure that I'm not so bullish that if and when that intermediate pullback comes, and the longer this intermediate run lasts, the bigger and the faster the intermediate pullback will be. Right? There'll be a catalyst, something will come out, but it'll be relatively big, and especially with the lack of foundation that we have below us from a volume standpoint that can hold us up and make it more of a grind to the downside. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll and hit either agree or disagree. If you click disagree, comment as to why down below. What are you looking at? Everybody's got their opinions, but what's driving your opinion? What are you looking at that would tell you that you're either a lot more bullish than I am, or that you're more bearish than more bearish than this idea of of a impending pullback coming up in the short term. So let me know down below what you're seeing that's driving that. All right, so you can see again from the beginning of the year just how the risk trade has been doing. Right, emerging markets are down, crude oil's way down, gold, long-term bonds, real estate, large cap stocks, the dollar, all up. So it's definitely a risk off trade since the beginning of the year, and we've had a little bit of a run, but the reality is, even just looking at this week in its own little bubble here, and how it did from a risk appetite standpoint, crude oil actually did do well in emerging markets. Small cap stocks outpaced large caps. Emerging markets outpaced developed, which really didn't go anywhere. But you notice how bonds and gold, which started the week down, ended up higher. Right, the dollar ended up higher. In fact, if you look at the chart for the dollar, it's just been such a strong mover. There's look at that move higher. In fact, on the weekly chart, and when you look at its Hakinyashi candle, I mean, that's a pretty darn bullish candle. It's closing above a lot of highs here. It hasn't closed above those highs, but it's a pretty big move to the upside with PPO starting to rise. Now, PPO for the dollar doesn't ever really get too big, but this kind of gives you an idea of just how bullish this week was. And we've had weeks where we've had bullish weeks where we've closed above, some previous candles and then didn't go anywhere. So keep that in mind. If you look at some of the major currency pairs here with the dollar, I mean, look how bearish the euro is. And then you look at like the pound, US dollar, and you can see it's been pulling back towards a 200-day moving average. You look at the Aussie and you see how bearish it is, and now you see why, especially with the Aussie, in this bear trend, and for that matter, the euro too, stuck in this strong bearish trend. It's hard for the dollar to be too bearish until you see some reversals in these charts. Here's the pound again. It's at least it has a golden cross and has a little bit of a run. Of course, the Japanese yen is also in its little golden cross environment, but that's actually a risk on move when that's on there. And then the Canadian dollar, you can see, has been flirting. The dollar's been flirting with a bearish environment against the Canadian dollar, but hasn't really broken out of a trended one way or the other. But that, if you look at the trend quality index for the dollar, just pull that up for the dollar here, that's about as strong of a move as we've had in a long time. We've had all this noise on the weekly chart, right? All this noise pretty much since the beginning of 2019. We had a big run at the end of 2018, a bunch of noise ever since then. So go back here a couple of years to see how strong the trend is now, because it's above 80 and above 5. So it's a strong trend as we've had all the way through here. I mean, really, it was that last move is the last time we've been as bullish as we are right now. And getting to this level, that suggests that we could be bullish on the dollar for a little bit of time. Again, that's not typically bullish for equities. So just be aware of that, the impact that a strong dollar, getting to 100 or above can have. I mean, the last time we had a strong run on the dollar to get up above 100 was the elections. We had, when we came out actually before the elections, and then here's the move. We were already pretty bullish before the elections, and then there's the move coming out of the elections. The dollar was relatively strong, and then it just tanked, and that's what kept the stock market doing so well in 2017, is because the dollar tanked, and that's something we want to keep an eye on. You look back at the S&P 500 at the end of that 2016 time frame. Let's go back those 5 years. You go back to the end of 2016. So here's 2017. So here's the end of, here's where the dollar started the rally, right? It was in September. You can see how bearish that we were until the elections. And since then, remember, the dollar peaked at the beginning of the year of 17 and dropped off, and that's what allowed the stock market to be as bullish as it was in 2017. Just very, very bullish move all the way up to the end of 18. But not without its own period of volatility here and here, right? And that's typical of big dollar moves to the upside. So we're rallying right now with the dollar move to the upside. The question is, we've already been rallying with how much longer can the market overcome that headwind? Because a strong dollar is a headwind for equities. All right, now let's take a look at the sector and how they've been doing. Let's look at the 12 grid first for the sector, and you can see these cyclical areas doing really, really well. Industrials popping up, but again, look at real estate and look at utilities, and for that matter, staples getting an overbought cluster. This is not typical. This is not very typical of a risk-on move to see utilities and real estate and staples outperform. If you take a look at the relative strength of utilities and staples on a weekly chart here, you can see the RSI is crossed above 50. The MACD down here, the 1226.9 MACD, is crossing up above. You have the 50-day moving average up above. Well, this actually here I have to change it actually to, let's do, since we're on a weekly chart here, 10 and 40. The 50-day moving average has crossed up above the 200-day moving average. So when you have these areas, these safety areas of the market outperforming, look at the move on real estate. It's starting to make a run. RSI moving up, MACD crossing above 0, getting up above the 200-day moving average. I mean, that's not your typical risk-on type move. I mean, it's okay for them to go up. It's not necessarily okay for them to outperform on a relative straight standpoint. And let's go look at now this chart here to see how they did just this week alone. All right, so we'll come back here to February to a 10-minute chart, and again, you can see, look at real estate up there, discretionary technology and communication services all did well, but utilities and real estate also did very well. And again, not what you would expect to see in a bullish market, to see those two starting to outperform. That's another one of those red flags that we want to keep our eyes on. All right, so for our trade idea of the day, I want to take a look at American Express in that financial sector. American Express has had an interesting pattern. It did really well in earnings, pulled right back to the trend it was already on, and it actually continued higher. In fact, you can see the intermediate postures turning up, the near-term lines got in the upper reversal zone. If you take a look at its 3 green arrow chart, the MACD and stochastics have turned back above their moving averages and rolled back up to the upside. If you take a look at the long-term view for American Express, it's got a nice, good bullish trend. It's just trending higher to the upside. From a Bollinger Band standpoint, the bandwidth had pulled back, and we jumped up. We're in the path of least resistance above the value area here, moving to the upside. You take a look at its DMI. It's positive, it's still above 25. Negative, still below 20. It's got a strong trend going on right now. You look at its Ichimoku cloud, same thing, very strong trend going on here. And then if you look at its linear regression trend line, you can see that we broke above the first standard deviation channel, which is a good sign. Again, good sign to continue to move to the upside. I don't know how directional we'd want to be, as bullish as it's been, but it does set up for a good opportunity to sell this the mid 30s delta here at 133. Buy the 131, try to get at least 47 cents on credit. So that's what we did today in our Market Outlook live video, as we set this up as a limit order to try to get that 47 cents on a $2 wide. that gives us our enough credit to make this trade worth it on the upside. You can see the blue line is where the risk is, where the break even would be. Of course, I'm willing to lose a little bit more, so I've got a little bit of a volume node there that can hold us up right in that volatility area in case we do pull back. Again, it's always really likely our short strikes get hit and our short vertical spreads. So in case we do, that support should be able to help us down there. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link right there that takes you to our Market Outlook forums. Open up any new thread you have with questions or comments about anything we talked about in the video today, or for that matter, anything we didn't talk about that pertains to the topic. And let's keep this conversation going until our next video. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, and then join our site at marketscholars.com and our Facebook group. Again, thanks for watching, everybody. Have a great rest of your Valentine's Day and President's Day weekend, and we'll see you all next week.